From the line of Aditya Mongia from Kotak Securities. Please go ahead.
Hi, Aditya.
Hey, hi, Ram. Thanks for the opportunity. I'll start with the questions. The first one, more data-oriented. In your standalone segment, what has been the full year order inflows and what kind of growth visibility does it give you for next year?
So I think from the standalone or the MLL, I'm guessing your question is largely around the standalone MLL numbers, which is the contract logistics business. I think annual ACV for the year consolidated was on 270 crores, largely non-Mahindra business, Aditya, and that should be a fairly large amount of that should be some amount of it has already been monetized during the year, and therefore is in our Q4 run rate. But a fairly large amount of that is something which will flow through the rest of this financial year.
So sorry, you said 217 as and
70.
Sorry?
270, Aditya.
270. Understood. The second question that I had was more kind of getting a sense. You said in with Flipkart you are doing an integrated line haul service. And does that mean that Flipkart is outsourcing to you the line haul part of business, or how does it?
Yeah, we do. We right now do. We have traditionally been doing line haul services for Flipkart earlier as well, Aditya, and we have largely been doing what we call trip-based services, which is point-to-point, freight operations, surface freight operations for them. Earlier this year, we actually started kind of a network operation for them. So we essentially operate a fleet which is location agnostic. It works across the entire Flipkart network on a dedicated basis for them, and that's an operation we launched, I think, in September last year, and September last year around Independence Day, and of course we are looking at further expanding that this year.
Understood. I think just to kind of round it up, last question on my side and then get inside the queue. See, if you are doing 80-85% capacity utilization on your express business, shouldn't one be worried with the kind of losses that the business still kind of reports? Just kind of not clear whether it's a good thing or a bad thing to still be having losses at that kind of high utilization in the largest cost element that you have.
No, I think it's a good. I mean, I think I tried to answer this when Alok asked the question earlier, but I think we are, as I said, we are around 80 to in the early 80s in terms of line haul utilization, and we think there is an upside there, right? Especially as some of the volume increases, we'll obviously add more scheduled fleets there as well, and there is more goodness to be had there. The second part of the big part of it is actually on pickup and delivery costs, which we have not seen most of that goodness come into our financials yet. So that's a big priority focus for us right now. The third one is around site operations and physical infrastructure on the network. So not the entire part of we need to kind of improve our gross EBITDA levels around 15% over the next 6 months, over the first 6 months of the year. Not all of that is actually coming from line haul. A substantial part of that is actually coming from site ops and pickup and delivery as well. A smaller part will actually come from line haul. A lot of the line haul improvements have already happened. So as I mentioned earlier, from like mid to late 60s, we have gone to the early 80s in terms of line haul utilization, and that's what we're showing partially in the improvement in the numbers as well. So obviously, that will not be the primary vector. The other levers will not be the primary lever. The other levers will be what we are focusing on right now.
Sure. Those are my questions. I'll get back into the queue. Thank you.
Thanks, Aditya.
Thank you. The next question is from Amit Dixit from ICICI Securities. Please go ahead.
Yeah, hi. Good evening, everyone, and thanks for the opportunity. I have 2 questions. The first one is, if I look at the contract logistics business, while revenue has grown by 15% YOY in Q4, gross margin has grown by just 2%. So just wanted to understand what is playing out there. Is it that because of higher e-commerce share, we are having this kind of muted growth in gross margin in contract logistics?
So, Amit, I think it's a mix of multiple things. I think, firstly, we obviously have had a pickup in transportation services more than warehousing. So there has been a mixed impact on the incremental volume, which is seen of around approximately 100 crores on on a year-on-year basis, on like 80 crores on a year-on-year basis. A substantial amount of that, a reasonably large amount of that has been transportation services, and that's had an impact. And the second thing which you would have seen probably you might see later on in the slide deck, right, which is uploaded on the investor deck, is on the warehousing and solutions business, especially on warehousing. We have had a lower year-on-year yield from that business. As you're starting up new sites, there's typically new sites take 3 to 6 months to hit the right level of earnings in them. And in the last 4 months of the year, we've had quite a few sites which have been under construction and a launch, and we obviously carry a certain pre-operative cost or a pre-launch cost for that. That should settle down in the first half of this year. I think we are launching several new sites by May this year. So there is a carry of that part, and that the realization of the gross margin at a pre-Ind AS level per square feet should go up by 10 to 12% through this financial year. So it's a combination of those two things, which I think are resulting in earnings not being so accretive, but these are all early cycle parts of a 4-5 year contract. So over a window of time, they will actually settle down to the right level of earnings. And I think there is a slide later on the deck which actually shows you the warehousing margin as well. We have it included normally for your reference.
Great. Yes. The second question is on B2B Express. Again, what we are seeing is that even in gross margin level, we have a loss of roughly 6 crores. While it is appreciated that, we are trying to optimize the lane mix and everything, but despite being at a high utilization level, despite optimizing the lane mix, we are still incurring this gross margin loss. So, what kind of volume would give you break even at gross margin level, at least in B2B Express?
Well, I think it's not a pure volume game, right? Amit, otherwise we would not have shown the improvement we showed this quarter, right? So I think, as I said earlier on, the three big parts to the puzzle at a pre-gross margin level. And the first one is around the line haul cost itself. There, the utilization is around 80-85%. We believe there is still a 5 to 10% improvement potential there. Right, especially as new volume comes in, we'll add more lanes there or add more lines there as well. The larger part which we are really focusing on right now is pickup and delivery, which is approximately 18 to 20% of our cost, right, and obviously the site operations. So collectively between the three of them, we think there's a 15% improvement potential. There is some volume growth inbuilt into that model, but we are on track to accomplish that. So I think it's just important to understand that while line haul is the largest part of our cost, it's not the only part of our cost. There's goodness to be derived in other parts of our cost structure as well. And while we attack line haul first, for the obvious reason that it's the largest part of our cost structure, there is work going on in other parts of that cost elements as well. And that's what we think will flow into the numbers more strongly in the next 2 quarters.
So basically, while we have guided that by Q2 FY25, we will be EBITDA positive or EBITDA neutral in B2B, is it fair to assume that by Q1 FY25, and at least we would be, at the break-even level on gross margin front?
Yeah, I think that's a pretty good assumption, Amit. As you know, I don't give guidance, but that's a good assumption.
Okay, great. Thank you so much, and all the best.
Thank you. The next question is from the line of Yash from iThought. Please go ahead.
Yeah. Most of my questions are answered, but if you could just help, what are the key metrics you as a company would be tracking to reach your targets of breaking even right in the contract logistics in the express business? And secondly, you mentioned that the realizations are lower because of new warehouse operations. So broadly, where do you see these realizations stabilizing, and that will lead to an improvement in the EBITDA margin for the the standalone business? Am I right for that?
Yeah, sure. So let me address the second part of the question first, because just so we don't only talk about express the whole time. So I think on the contract logistics part, I think earnings, as I said, with the three big drivers for us. One is volume. Volume is very important. As I mentioned, I think when Aditya asked the question, we have had annual contract value gain of around 270 crores this year. More than half of that is yet to be monetized, and so we will see flow through of the volume through the rest of this financial year. The second part is obviously cost control in terms of our operating costs across the sites. A lot of our business is longer term contracts, and therefore, managing guardrails and costs is absolutely critical. And the third one is really startup simulations. As we're adding up new sites every quarter, you're doing the startups well. Managing the startup window and shortening the startup window is extremely critical. Those are three big elements which are drivers for earnings growth. So, to your point, Amit, I think with the absence of the one-time charges and some of these things flowing in, we feel positive about the runway in terms of earnings growth in the contract logistics business. We obviously have to execute that well, but those are the metrics we track internally as well, and really it comes down to being ruthless in terms of how well we execute it, day in and day out. The express side of the business, I think for us, the important thing is to get the playbook right. I think as you've seen, when we've been successful with acquisitions such as what we've done with Meru or what we've even done with Whizzard, who has become a full subsidiary only now, right, or even with the Lords business, the freight forwarding business, I think each of them are focused initially has been not to just grow, but actually get the playbook right. So we now then have a scalable business. I think therefore, while there is an accent definitely on volume growth in express business, I think getting the cost structure right is a very important thing as well. So the last 3 months or 4 months, we have been really aggressively pursuing the right sizing the cost structure. That will remain a focus over the next 6 months or so. And so our operating metrics are really around the line haul costs, right? So getting the line haul costs right, getting obviously up and every cost elements right, and ensuring that service levels remain extremely high through the network, both in terms of TAT or customer promise dates, as well as in terms of depths, which is damages or excess or short shipments. So those are things we're really focused on. Obviously, volume growth is something which we all focus on. So I won't kind of label the obvious point, but the real metrics which we focus on is getting the costs right. Our endeavor is not just to make it basically be EBITDA breakeven by the end of the first half, but to actually build a scalable playbook between customer promise and cost structures and network efficiency, which we then can scale up consistently over a period of time. And that's actually when we start seeing.
And if we bar the one-time cost, of new warehouse operation, what would be the gross margin, warehousing gross margin yield, which is I think 18, which you have mentioned in the presentation. If we remove those new warehousing opening.
Yeah. So I think it's probably around 20 rupees. I think what you have mentioned there is 18 rupees for the quarter. These are pre-Ind AS levels. I think Aditya asked this question last quarter, so we added that footnote. But around 18 rupees per square feet, I think it will probably be around 20.
Right. Still that would be down on a year-on-year basis, right?
Q4 last year, yeah, it's still, but I think we've said this earlier as well. My own sense is when you look at warehousing margins on a full year basis, because the business is going to be reported on a quarter-on-quarter basis for your convenience. But ultimately, there are quarters when we are, for example, last year in Q4, we had peak in Q3 and we had some run-up of benefits flowing through in Q4. So those got accounted in Q4 and therefore you saw a higher number in Q4. But those are periodic numbers. I think it will stabilize very honestly at around 20. I don't see it going to 22 this year. But I think we go to 20 and if you get a 2%, 2% improvement in gross margin on roughly a 1,000 crore business, we think that will actually be a big earnings lift.
Fair point.
Thank you. The next question is from the line of Sumit Kishore from Axis Capital. Please go ahead.
Hi Ram, my first question is on last mile delivery, where we got the first full quarter benefit of Whizzard. So from this level, organically, how does the business grow for the next 1 year? If you could speak about that. And, the certain gross margin this business has done in this quarter, what is the outlook going forward, for the last mile delivery business?
Yes, I think obviously we've seen the full benefit of the last mile delivery business this quarter. And as you know, Sumit, I think as I mentioned earlier, roughly half our business is still in MLL, within MLL, and the other half of it is actually in the Whizzard business. I think as you look forward, I think the two big drivers from a margin perspective, obviously your gross margins improved in Q4 compared to last year, and I think on a full year basis as well, we have seen and reasonably strong improvement in gross margins, but margins are still low. As you can see, the gross margins are around 5.5%. As you look forward, I think this year we are expecting FY24-25 to be a year of strong growth. When I say strong growth, I think, as you know, we kind of, our kind of a broad expectation is a mid-teen growth across our entire business. So I do expect last mile will outstrip that growth pattern, right? Given where we are in terms of order intake and network expansions in that space. Larger focus there obviously is on gross margins. I think we are around 5% today. Over a period of time, we want to take gross margins up to 8%. That's going to come from 2-3 things: increased purchasing power. As you know, we are combining this business in terms of buying ICE fleets and so on from partners. So that's one big lever. The second one is consolidating operations or co-locating operations more consistently. Right? We have multiple sites across these businesses which are within a few kilometers of each other. And we are looking at saying how do we get some network and infrastructure leverage. And the third one is driving better productivity. With Whizzard, we get a very strong technology platform which allows us to manage workforce productivity a lot more aggressively. That work has already started right now, Sumit, since after we completed the second tranche and it's become majority subsidiary. So over a period of time, I think these three things will actually help us grow margin as well. I won't specifically comment on how much of that will happen in this fiscal, but we have in the past told you all that our broad expectation is that our last mile delivery business should keep an 8% gross margin, and we are around 4.5 now, so we have that gap to bridge. The Whizzard business reported around 6.5% gross margin for the quarter, so it's kind of a little bit ahead of the MLL part of the last mile delivery business. And so there's some learning and synergies will flow through as we have now completed the majority part of the acquisition. But focus for this year, Sumit, is obviously top line growth. We expect high teens or even probably early 20% kind of growth in the business. And a substantial focus is on getting crossing a large part of that journey towards 8 to 10% in terms of gross margin.
Very clear. My second question, is just to understand how with 3.5% quarter-on-quarter volume growth, line haul utilization could be improved from early 60s to 80-85%. So is that because you've brought the fleet size down, or how does utilization improve so much with a 3.5% volume growth?
Great question, Sumit, and I'm glad you asked it because I think it's the party trick in the puzzle, isn't it? So I think the key thing, of course, has just been our entire work on redesigning the network. So really, in a plain vanilla way, you'd probably look at this saying that volume went up by 3.5%, so utilization should go up by 3.5%. That just assumes that we are running the network exactly the same way. I think a lot of work has gone in terms of redesigning network, changing network vehicle frequency. So we are actually running fewer kilometers now on load than we did earlier. Right? And that's actually part of what's driven that improvement across the entire network. Obviously, we've kind of, at the right points on network, cut down some of our schedules as well. So instead of, let's say, running daily on some locations, we've actually driven we've actually moved in and taken some cutoffs in between or changed vehicle frequencies. We redesigned the routing path of the network. So those actually have added up to a fair amount of that improvement in terms of utilization. Probably 7 to 8% of the improvement in utilization has come from that. 3.5 to 4% has come from pure volume. But inside the 3.5% of volume growth, we have also specifically churned some customers on lanes which are completely unprofitable and added customers into lanes which were very profitable. So there are some services, for example, I won't give a specific pin code, but let's say if we are running at 25-30% utilization on some pin codes, or some lanes, we've actually kind of reduced volumes in those lanes and actually brought in volume to the other lanes where we can bring in capacity. So those are three things we've actually added capacity utilization. Which is a great question, Sumit. I'm glad you asked it because that's been a big part of our focus in the business, has been reorganizing the network, and that's why it took time to do it as well. If it was just a pure volume game, we would have probably done it much earlier.
Sure. So that is some of my understanding. For the next 2 quarters, if you manage again 3.5% volume growth quarter-on-quarter, along with the cost saving initiatives, that would be more than enough to get you to EBITDA breakeven for the B2B express business by Q2 of FY25.
So we're obviously paraphrasing. History is not a good indicator of the future, always. So I will not. I'll resist the temptation of. I'm going to pass on that question. Right? I think what I can tell you is that we are confident of hitting EBITDA breakeven by Q2.
Sounds good. Wish you all the best. Thanks.
Thank you. The next question is from the line of Harshal Mehta from PL Capital. Please go ahead.
Hi, sir. My question is regarding the B2B part. So actually, earlier understanding what I had is we need to scale up to like 35,000 run rate monthly to achieve EBITDA breakeven. But now with this current cost optimization thing, could it be like achieved with even like 30,000 volume monthly?
So actually, I think what I had said earlier on is that we need to get volume to grow by around 30% to be able to hit EBITDA breakeven. I think obviously, as all of you have noted, we have seen some softness in the last 2 quarters, especially the last quarter and a half on the express business, and therefore our emerging focus has been on trying to drive better cost optimization. I think the question we've always been asked is, if we ran the business as it is right now, and how much more volume do we need to have breakeven? The answer to that obviously was 30%, but that's not the only way to hit breakeven. Right? The answer is a combination of both. And so what we have been focusing on is driving volume growth, but driving the right volume growth first. And that's why I skipped on answering Sumit's question in the affirmative. Because we will need volume growth at some point in this journey. Volume growth will be important, but right now I think there's more to be accomplished from a cost improvement perspective. It is likely that if we can, as we hold this cost improvement, we may not need that 30% growth in volume to hit EBITDA breakeven.
Got it.
We are focused on that because ultimately the game doesn't stop with making EBITDA breakeven. That obviously is a bit of a sticker shock issue right now, given the carry it has on our earnings. But we've acquired and are building the business to become much larger and be more impactful than just being EBITDA breakeven. So the volume focus remains pretty strong. It's just about getting the right volume first and then focusing on overall volume.
Got it. And sir, how much would be the white space in warehouse currently?
3%.
Okay, and sir, capex for next year?
Correct, Mike. It's around 4% now. I stand corrected, it's around 4%.
Okay. And so capex for next year?
Similar to this year.
Okay. Thank you, sir.
Thank you.
Sorry, similar to last year.
Thank you. The next question is from Ketan Athavale from Robo Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. In our PPT, we have mentioned we will reach 10,000 crores revenue by FY26. So I wanted to know what will be the drivers for the same. And if you can give the margin expectation for next 2 years, EBITDA margin.
I'll answer the first question first, Ketan. We don't give guidance on analyzed margins. So I will unfortunately have to pass on that question. I think on margin, what we have said is over the cycle, we expect to be around 2.5% to 3% on the contract logistics business, which is MLS, standalone for the large part, and we expect the other businesses, which is the network businesses, to be around 3% to 4%. That goal still remains. I won't timestamp that goal to a specific reference. In terms of revenue growth, I think our focus really has been on 2 things, and I think one has to split the business into 3 parts as you look at our revenue story. The first one is our contract logistics business, which right now is running around 4,500 crores. We expect that to grow at around 15% to 17% over the next 3 years. This year was a particularly challenging year as we saw a slowdown across most of our end markets. But as I said, we are getting back to that growth point now, and we are hoping that we can sustain that both through market growth as well as more penetration by us. So that's one part of the growth, which probably gets us to around 6,000 crores in that range. The second part of it is the network services business, which kind of all subscale now. The forwarding business had made progress. It's kind of moved a bit backwards because of global macros. The B2B express business is in a turnaround phase, and the last mile delivery business, of course, is in a scale-up phase. So those three businesses, we do expect over the next 3 years or a little bit more than 3 years, will scale up to 750 to 800 crores each. Right? And that is not a very significant growth. In percentage, it looks large, but in terms of the markets which we operate in and the value propositions we have, if we develop the right offerings, we believe we are very confident that we can actually drive that growth. Now, for example, the express business today, even at 800 crores, will probably be around 7 to 8 lakh tons, which is not a very large number in the context of the overall industry. It will still probably be around 6%, 5 to 6% market share. So these are not exceptional moves. They're big moves, but they're not something which we think are in complete stretch. And so that's the second part. So between 6.5 and 2.5, we get around 9,000 crores. And obviously, the mobility business is right now running at a run rate of around 350 crores. 328 crores actually was our reported numbers for the year just ended. And we're exiting at around 350, 360 crores of run rate. And so that's something which we obviously are a bit dependent on larger macros on that because return to work, etc., has to stabilize. So there's a little bit of, I would say that's the one which is a bit hard one to timestamp, or the hardest one to timestamp. But those are the three buckets in terms of driving our growth. The way we are organized inside the company, each of these businesses has individual business leaders. There are specific business plans for each of them, and therefore, while they're individually focused on driving growth in the business, and that's what they're accountable for, while we focus on driving synergy across the business, that's a multiplier for us.
Yeah, got it. Thank you. And what will the depreciation stabilize at current run rate, or do we expect there to increase?
I think there should be moderate increases. As I said just now, Ketan, I think the earlier person who asked the question, we do expect to add capex in the same line as what we are doing now, and that's something which I think will continue. I think on the warehousing side, you've seen our yields at a pre-Ind AS level around 12.5%, 13%. So we do continue to add warehousing over a period of time. As we add the warehousing, you will see an RTU asset line impact on the depreciation line because those assets are reclassed and then reported as RTU assets, right? And there's a depreciation and an interest cost they carry, right? But those are the two big things which will actually move. We don't see a substantial other shift from an organic basis across our business.
Thank you. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from Nitin Gandhi from InnoQuest Advisors. Please go ahead.
Yeah, thanks for taking my question. Just a small confirmation, these 5 businesses which are making losses at PAT level, do we expect them to be break-even or PAT positive in this year?
I'm sorry, can you repeat that question? I couldn't get it.
The 5 businesses, that is Mobility, Express, 2x2, Wheeling and Whizzard, which are in losses. Will they be break-even or PAT positive this year?
Yes, Whizzard will be, I think across those businesses, I think Whizzard, the large business will be PAT positive. The mobility business is PAT positive on a run rate basis, will be profitable for the full year, as it was this year as well. And 2x2 and Wheeling also we expect to be profitable for the year. All of them should show profit improvement this year. I think the challenge will still remain the express business. I think we are expecting to be EBITDA positive by the second half, by the second quarter of the year. Between EBITDA and PBT, we have approximately a 30-35 crore rupee kind of impact between the interest on the long-term debt, the write-off of the fixed assets, the depreciation of some of those assets, right? And so those will probably continue over a period of time till we get volume to recover that. But the rest of the businesses, we expect they should be profitable and should accelerate their profitability this year.
Wish you all the best for Express. We'll talk maybe after second half. All the best.
Thank you. The next question is from Anshul Agarwal from MK. Please go ahead.
Hi. Thank you for the opportunity. Ram, what could be the sustainable gross or EBITDA margins for the express business once our cost optimizations are completed?
Sorry, Anshul,